Moving on then, India's core sector did badly in August with output declining by 1.8%. The government fiscal data shows that government capex also did not pick up. The RBI also released the current account data for the June quarter. Latha is here to put all of that data into perspective. Latha, good morning.
Well, end of quarter always means a lot of macro data, and some of this has not been very flattering, certainly not flattering to growth. And that in particular starts with the core sector data. The 8 core sectors, coal, electricity, cement, crude oil, gas, that set has declined, contracted by 1.8%, which is a bit shocking. We have seen low growth, but we have not seen a minus 1.8 in a long time. And the big sectors that fell or contracted were coal, crude oil, natural gas, cement, and electricity. Now, what's common to all this? They don't do very well in heavy rains. And that's exactly what has perhaps led to this contraction. Year ago, August was a month of poor rains, whereas the August 2024 has been a La Nina August, leading to very heavy rains. Perhaps that explains the lower output in perhaps all infrastructure-related sectors. It was only steel that has shown a slight growth, a low single-digit growth. Let's come to government capex. It's likely that that's also suffered for the same reasons. The overall fiscal deficit is lower compared to year-ago levels in August and in April-August, but that's because expenditure has been lower. Tax collections, and that's a bit surprising. Overall tax collections have grown 11.7%. In the past many years, it has been contributed by a very strong growth in income tax collections, but that in August has actually fallen by 25%. It's not very alarming because it's always the September, the June, those are the months when advance taxes are paid, that it's really important. But nevertheless, this is a bad sign. We have to watch it. Government capex has fallen by 30% year on year if you took April-August. That would be bad because in the election months, the government didn't spend. But you would expect August itself to have been better. August also was 20% lower than year-ago August. So clearly, it's probably the rains, but government capex is not catching up as much as we want it to. Finally, let me come to the current account data, which come in, which is the pleasant set of numbers. Current account deficit is marginally higher at 1.1%. Q4, I'm talking about the April, May, June quarter. It's a very lagged data. Q4 of last year was a surplus, but you should compare year on year. If you compare year on year, last year was 1% current account deficit as a percentage of GDP. This time it is 1.1. Not a very big difference at all. It's a very good number, actually. If you're below 2%, it's a very good current account deficit. And this slightly higher current account deficit is because trade deficit is higher, merchandise trade deficit. Services is a surplus, but it has not grown as much as it has grown in previous years. The other point is the capital flows. In the capital flows, last year we had a surplus of about 24 billion flowing in. Good FPI, good FDI, good ECBs, all that in 23. 24, all that is negative. FPI is negative, FDI flows have been very weak, and ECBs raised by Indian corporates also very weak, not too much capex perhaps, and that's led to a lower balance of payment surplus. None of this is earth-shattering. It just means that liquidity in the system was less. But otherwise, nothing to complain about the external data.
Nothing to complain about. Latha, thanks a lot for that. But